Welcome to the Rim Break Rodeo. We hope this video helps.
In this video, I will explain money creation. Money creation is a fundamental concept in economics, referring to how the total money supply in an economy expands. It's a fascinating process involving both central banks and commercial banks. While central banks issue currency, commercial banks are the primary drivers of new money through their lending operations, significantly impacting economic activity. Commercial banks are central to money creation. When a bank approves a loan, it doesn't just lend out existing money, it actually creates new money. For instance, if a bank lends $1,000, it credits the borrower's account, effectively adding $1,000 to the money supply. This is possible because banks operate on a fractional reserve system, holding only a portion of deposits and lending out the rest. The money multiplier is a key concept in understanding the extent of money creation. It shows how an initial deposit can lead to a much larger increase in the overall money supply. For example, if the reserve ratio is 10%, meaning banks keep 10 cents of every dollar deposited, the money multiplier would be 10. This implies that an initial deposit of $100 could potentially expand the money supply by $1,000. While commercial banks create money, there are important limitations. The central bank sets reserve requirements, such as the cash reserve ratio and statutory liquidity ratio, which dictate how much banks must hold. For instance, if the cash reserve ratio is 4%, banks must keep 4% of deposits with the central bank. Public preference for holding cash also limits this process. Central banks use these tools to manage inflation and ensure financial stability.
Thanks for watching. Consider subscribing if we helped you.